Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Vale stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Vale is a mining and logistics company. It is the largest producer of iron ore in the world. It has 4 systems in Brazil for producing and distributing iron ore. They are called the Northern, Southeastern, Southern, and Midwestern systems. The Northern and Southeastern systems are fully integrated, consisting of mines, railroads, maritime terminals, and a port. The Southern system consists of 2 mining complexes and 2 maritime terminals. The company also operates 11 pellet plants in Brazil. 98% of iron ore is used to make steel. Steel is used in many things such as buildings, infrastructure, roads, bridges, medicine, auto parts, etc. China imports 75% of the world's iron ore. It is also the largest producer of nickel in the world. Nickel resists corrosion and is used to plate other metals to protect them. It is an important material for the batteries that are used in electric vehicles. It is also used in kitchen products, mobile phones, medical equipment, buildings, and jewelry. The company has a massive logistics operation in Brazil and other parts of the world. It controls every part of the process from mining to crushing to treating to shipping. It has a network of railroads, marine vessels, distribution centers, and ports. It is part owner of MRS Logistica. MRS transports the iron ore products from the Southern System mines to its maritime terminals. It also charters dry bulk vessels to transport the products to its customers. In addition to iron ore and nickel, it also produces manganese, ferroalloys, copper, bauxite, potash, kaolin, and cobalt. The company is headquartered in Rio de Janeiro, Brazil, and was founded in 1942. The ticker trades on the New York Stock Exchange, Spanish Bolsa, Sao Paulo, Mexican Bolsa, Deutsche Börse, Buenos Aires, and London Stock Exchange. Let's get started with the model. This is a large cap company, 98 billion market cap. They're trading at $20 a share, and they have 4.8 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow is really strong up through 2020. Then it exploded in 2021 at over $20 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was also their blockbuster year in 2021 at over $22 billion. Revenue is a sales for the company, and that grows each year up to $55 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are all the expenses directly related to generating the revenue. This includes all the expenses to extract, to crush, and to deliver the commodities. Revenue minus cost of revenue gives you your gross profit, and that more than doubled since 2018, up about 50% from 2020. Below that is their operating expenses. Their operating expenses are lower in 2021 compared to 2020 with higher revenue, so they have really good margins. Below that is their operating income. They spent $1.4 billion of interest on their debt, which was a lot lower than 2020 and 2019. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. Below that is their pre-tax income, then their taxes, and the bottom line of the income statement is their net income, which was more than double all 3 years combined. This is the company's income statement directly from their financial reporting. They had $55 billion of revenue in 2021. China imports so much iron ore, it makes up more than half their revenue. Ferrous minerals is iron ore. Nickel and copper make up most of their base metals. Below revenue is cost of revenue, and below that is their gross profit, which is $33 billion. Their gross margins are unbelievable, 60%. That's gross profit over revenue. The industry average is 30%, and their net margins are also amazing, 41%. The industry average is negative. They spent $481 million in selling and administrative expenses, $549 million in R&D, $648 million from stoppages, They passed through lots of losses on the Brumadinho fiasco. 2.6 billion. Last year was over 5 billion. Before that it was over 7 billion. In January of 2019, a dam collapsed, which resulted in a flow of debris that destroyed their facilities and also killed 270 people. This happens a lot with mining companies. When things go wrong, it can really go wrong and cost them a lot of money. Even with the big expense from Brumadinho, they still have a ton of operating income, 28 billion in 2021, more than double 2020. And they had over 22 billion of net income in 2021. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. They generated more cash flow than ever in 2021, close to 26 billion. They spend a lot in CapEx each year. That's investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. They had a ton of free cash flow, so they paid a huge dividend in 2021. They also bought back lots of stock, over 5 billion. When a company buys back common stock, it decreases the shares outstanding, and it makes your shares more valuable. In most years, they pay down more debt than they issue. Especially in 2018, they paid down almost 8 billion of debt, issued only 1.2 billion. Two numbers I like to track are revenue and operating cash flow. And those two numbers have been going up a lot. Look how high they are in 2021 compared to prior years. Their revenue and operating cash flow is projected to decrease over the next few years. I guess it's so high now, it can't go up forever. Even decreasing 10% a year, it still gives them a ton of cash flow. This is their investing and financing sections from their statement of cash flows. In their investing section, they spent over 5 billion in CapEx, and that's a lot higher than 2020 and 2019. They sold all their stock in Mosaic and received almost 1.3 billion of cash flow. They had a cash outflow of 2.5 billion. This is part of their business that they sold off, so it's in the discontinued operations section. In 2022, anything related to that business won't show up in their financials. In their investing section, they had a cash outflow of 6.6 billion. In their financing section, they paid down 2 billion of debt. They paid over 13 billion of dividend payments. Last year was only 3 billion. And they bought back $5.5 billion of stock. So they had a cash outflow of 20 billion. Let's look at the capital structure. 34 billion of equity, 14 billion of debt. They're 71% equity, 29% debt. Their net debt is 1.9 billion. So they could pay off most of the debt with the cash on their balance sheet if they wanted to. I gave them a WACC of 10.5%. That's the lowest WACC on Finbox. And that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 125 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $121 billion. We divide that by 4.8 billion shares. And we get a calculated stock price of $25. They're trading at $20, so they're trading at a 19% discount. It's a buy according to the model. The last time I did this company was in November, and they were trading at $12, and my price target was $23. And they're getting pretty close to my price target. My price target has come up a little bit since their fourth quarter was so solid. Their revenue is projected to decrease 11%, so I decreased their revenue 11% for the next 4 years. That's how I got their future revenue estimates. And they convert on average 28% of their revenue into free cash flow. So I multiplied their future revenue estimates by 28%. That's how I got their future free cash flows. The website Simply Wall Street is in the other direction as me. They're at $11 a share. They're saying it's 78% overvalued. 9 analysts priced this stock and the average price target is 18. The low is 11, the high is 22. This is where the stock has been trading the last 5 years. The stock has come up a lot the past few months, but it's still trading below where it was a year ago. And their RSI is 69, which indicates the stock is overbought, which means it may be overvalued. A low RSI indicates the stock is undervalued. If you're a big fan of technical indicators, you may want to avoid the stock. This bottom chart is the price of iron ore for the past 5 years. You can see this stock price pretty much tracks the price of iron ore. So that's how you really predict this stock price. If the price of iron ore goes up, so will this stock price. And if it goes down, so will this. In the past 5 years, the S&P 500 went up 82% and this stock went up 98%. Plus, this stock pays a really high dividend. So this stock has performed much better than the S&P. They paid a crazy high dividend in 2021, close to 14%. A few months ago, it was 20% because the stock price was a lot lower then. And look how high their dividend payments are. They've been bringing in so much extra cash recently due to the high price of iron ore. And they can afford it. It's only 59% of their net income, 65% of their free cash flow. They've done 3 stock splits, a 3-for-1 in 2004, 2-for-1 in 2006, and another 2-for-1 in 2007. They have a low beta, 0.64, so the stock is not too volatile. It's gone up 15% in the past 52 weeks, while the S&P is up 14%. The 52-week low is 11, the high is 23. And the stock is trading above its 50-day and 200-day moving average. This is a really popular stock. Nearly 40 million shares are traded each day. Of the 4.8 billion shares outstanding, 4.4 billion are on float. 25% are held by institutions and only 1% are shorted. This is their dividend yield since 2011. So you can see it's at its highest point ever. But of course, the forecast is for their dividend to decline over the next couple of years. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have about $15,000 today. It's a 4% annual return. You can see how cyclical this industry is. If you invested 10 years ago, you would have had to wait 9 years to turn a profit. But if you invested 5 or 6 years ago, you would have 10x'd your money. 80% of the shares are held by institutions, 11% by the general public, and 9% by public companies. Capital Research is the biggest shareholder at 31%. Then Banco do Brasil at 9%. When I worked in New York, I dealt with Brazilian banks, and we used to lend money to Banco do Brasil. BlackRock at 7%, Mitsui at 6%, and Brazilian Development Bank owns 4%. This bank is controlled by the Brazilian government. Since they were so profitable in 2021, their PE is 4.3, that's stock price over earnings per share. Their price to sales is 1.8 and their price to book is 2.8. These are really good ratios. Let's look at their non-current assets. 1.2 billion of judicial deposits. This money is related to their taxes they have to pay the Brazilian government. And they have over 11 billion of deferred income taxes. This will help reduce their tax bill in the future. They have 1.8 billion of investments in joint ventures, 9 billion of intangibles. A company gets intangible assets when they acquire other companies, and 42 billion of property, plant, and equipment. Let's look at their non-current liabilities. 13 billion of debt, 3.4 billion of debentures. Debentures are unsecured debt issued by the company. So this is debt Vale issued. 2.6 billion of other, 2 billion of refis, this is related to their taxes, 1.9 billion of deferred income taxes, 3.4 billion of provisions, this is money set aside for future potential losses, 2.4 billion of Brumadinho, 7.5 billion of dams related to Brumadinho, 1.3 billion of liabilities related to their joint ventures, 1.8 billion related to their gold and cobalt streaming, and a small amount in other. They have a really high return on invested capital of 68%. They can cover their interest payments 21 times, an amazing ROE of 65%, and a good current ratio of 1.5 and a good quick ratio of 1.2. Let's look at their current assets. 12 billion of cash, 4 billion of receivables. This is how much money other companies owe Vale, and 4.4 billion of inventory. Let's look at their current liabilities. They owe 3.5 billion to their contractors, 1.2 billion of loans, 2 billion of other financial liabilities. They owe the government 2.2 billion, 1.8 billion of liabilities related to their joint ventures, 1 billion of provisions, and 1.2 billion to Brumadinho. They generated 21 billion of free cash flow in 2021. They have over 7 billion of working capital, and they pay out 13 billion in dividend payments. So the company's really well funded. They have over 14 billion of funding. The best way to look at ratios to compare them to companies in the same industry. There are 39 companies in the same industry as Vale, and Vale ranks third in market cap, Their ratios are better than average in every single category. Their PE is a lot better than average. It's a lot better than BHP and Rio. Same thing with their price to free cash flow and price to sales. A lot better than average and a lot better than BHP and Rio. Vale will always have better price multiples than BHP and Rio because BHP is in Australia, Rio is in the UK, and Vale is in Brazil. Brazil is a much higher credit risk than the UK and Australia, so their stock price will always be artificially lower due to that. You can see their revenue is not that much smaller than BHP, but their market cap is about 1/4 the size. To summarize, I have them trading at a 19% discount, and these mining stocks have really been paying off lately, and I think there's still more upside. Because I think due to a time like this with a war going on, a lot more people invest in commodities than in times where there's less craziness going on. Even if the stock goes down a little bit, you still collect your great dividend payment, so it seems like a win-win. I rank their free cash flows, revenue, and ratios 10 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.